Welcome back to Talk Tickers. You know why you're here. We strip down the earnings calls, we parse the filings, and we decode the management speak so you don't have to.
Exactly. No hold music, no safe harbor statements.
Today we're looking at a behemoth in the kidney care space. We're dissecting DaVita, ticker DVA.
And we're catching this company at a really fascinating friction point. This is the Q3 2025 report. And if you were watching the tape when this dropped, you saw the reaction.
Oh, yeah.
It wasn't just a sell-off, it was a rush for the exits.
It got ugly fast. The stock took a 6.2% haircut right after the print?
A 6.2% drop, yeah. And this wasn't just, retail panic on light volume. Volume spiked. I mean, it went from a pretty standard 1.5 million shares to over 2.5 million.
Yeah.
The institutional money clearly had feelings about this.
And that right there, that volume spike sets up the whole tension we need to unpack. Because if you actually listen to management on the call, the vibe was completely different.
Completely. Their message was steady as she goes. They called the quarter in line with expectations.
And they reaffirmed their full-year guidance midpoints.
Which is the core disconnect, right? You have management saying, everything is going according to our plan, and the market is just screaming, we see a disaster.
Specifically an earnings miss and costs that are creeping up. So our job today is to figure out who's right. Is the ship steady, or is the market right to be seasick? We're going to look at the volume, the margins, and the huge policy swing factors that are looming for 2026.
Okay, so let's start with the hard numbers, the tape. Revenue came in at $3.42 billion.
Which is up 4.8% year over year. So on the surface, growth is growth.
Sure, but it was a slight miss against the street, a very slight one. But that's not what triggered the algorithms to sell.
No, it was the bottom line. It's always the bottom line.
That's where the pain was.
Yeah.
Adjusted EPS came in at $2.51.
Okay, let's just pause on that number. 251. The street was modeling something closer to, 317?
317, yeah. So that's not a rounding error.
No, that's a 21% miss on earnings. That's a huge deviation.
A massive one. Adjusted operating income landed at $517 million. And yet, like you said, despite that huge miss, DaVita's leadership didn't even flinch.
They just said it was consistent with internal expectations.
Right. And then they tightened their guidance ranges for the full year, but kept the midpoints exactly where they were.
It just highlights that gap, doesn't it, between how the street models a company and how the company models itself. The market fixated on the miss, on the costs.
And the tone of the call from management was, I'd say, neutral to cautious. It was all about navigating headwinds, not promising some kind of growth acceleration.
Okay, so let's get into the gears of the business. If you're looking at a dialysis company, the fundamental unit is the treatment, right? How many patients are in chairs?
And that's where you start to see the softness. U.S. dialysis treatments per day were down about 1.5% year over year.
For a business that relies on scale and fixed cost leverage, a 1.5% drop. That's a real blow to the model.
It is. Management attributed this to a triad of headwinds.
It's always a triad, isn't it? Let's break them down.
Okay, so the first factor is just the grim reality of healthcare, mortality. They had a really severe flu season.
Right. And when mortality rates rise, the census, the total number of patients, it just drops.
Exactly. It's the dark math of the industry. It takes time to rebuild that patient base. So that was factor one.
What's the second?
Disruption. We had Hurricane Helene, which, physically stopped patients from getting to centers. But maybe more concerning was the lingering effect of that cyber incident from earlier in the year.
I remember the headlines, but I kind of assumed that was in the rearview mirror by Q3.
Operations are back, but the ripple effects aren't. That incident just messed up the whole admissions process. If you can't process the paperwork, you can't get a new patient in the chair.
And that creates a gap that doesn't just fill itself overnight. Okay, and the third factor.
Pure calendar bad luck. Day mix. Just fewer treatment days in the quarter compared to last year. It's a structural headwind that just happens.
I want to circle back on that disruption piece. They mentioned a metric, the mistreatment rate, which for anyone listening sounds like they're being mean to patients.
Right, but it's not that. In industry terms, it's about missed treatments.
So scheduled appointments that just don't happen.
Correct. That rate spiked during the cyber incident. And the concerning part is that while it's improving, it was still elevated in Q3. It hasn't fully normalized yet.
So you have a volume problem, fewer treatments. Now let's flip to the other side of the ledger. What's it costing them? Because the market seemed very worried about the margins.
This is the margin squeeze.
Yeah.
Patient care costs, or PCC, per treatment. they increased by about $5 sequentially.
Usually we just say wage inflation and move on.
And wages were a factor, for sure.
Yeah.
But there was a very specific driver this quarter that stood out in the footnote.
I saw this phosphate binders.
Phosphate binders. It's a pharmaceutical expense. Dialysis patients need these to regulate phosphorus, and DaVita is just dispensing more of them.
So a clinical necessity that has a direct financial cost.
Exactly. It's good for the patient, but it drove up their pharma expenses pretty significantly compared to Q2.
Okay, so costs are up $5 per treatment. To protect the margin, they need to make more per treatment, did they?
They did, actually. Revenue per treatment, or RPT, increased by about $6 sequentially.
So they covered the cost increase, but barely. A $1 spread is not a wide moat.
Not at all. And this is where their full-year guidance gets really interesting. To hit those targets they reaffirmed, they need a really, really strong Q4.
How do they bridge that gap?
They're banking on an acceleration in that revenue per treatment. They're expecting a boost from, seasonal flu vaccines.
Which they administer and get paid for.
Right. They've got some rate increases kicking in. But, and this is the key, they're relying heavily on the resolution of aged claim balances.
Aged claim balances. That is corporate speak for collecting on old iOS.
That's exactly what it is. It's getting paid on old bills.
Yeah.
And that could be really lumpy, unpredictable. They're essentially telling the market they'll hit their numbers because they're going to collect old debts in Q4.
That feels like a bold assumption to bake into a guidance bridge. If those collections slip into Q1 of next year, they miss.
It's risky, no doubt.
Okay, let's shift to the balance sheet. DaVita's known for being financially aggressive. What did we see this quarter?
Very active. On the debt side, they refinanced into a new $1.9 billion term loan. Just good housekeeping, really.
Okay.
But the buybacks were the headline.
How much?
They repurchased 3.3 million shares in Q3 alone.
That's a huge amount. And there's that one detail about their buybacks that's so fascinating, the Berkshire connection.
Yes, the Oracle of Omaha. Berkshire Hathaway owns a massive chunk of DaVita, about 45%. And for regulatory reasons, they want to keep it right around that number.
So there's this weirdly specific contractual thing they do.
It's a formulaic machine. Just before the earnings call, DaVita buys back shares directly from Berkshire to keep their ownership percentage pinned at that 45% level.
It's almost automatic. If DaVita buys from the open market, the share count shrinks, which would push Berkshire's ownership up. So they have to trim Berkshire at the same time.
It is. And it signals they're committed to returning capital, even with all these headwinds.
One last thing on the operations before we look ahead. Management mentioned higher G&A costs. Why are they spending more there?
Tech investment. They're pouring money into clinical platforms, scheduling, revenue ops, and adopting AI.
The classic spend money to save money strategy.
That's the argument. They say it's necessary for long-term efficiency, even if it's a drag on margins right now.
Okay, so that's the quarter. A miss on the bottom line, headwinds from flu and hurricanes, but a management team saying, trust the process. But let's be honest, if you're an investor, you're not just looking at Q3. You're looking at 2026. And there is a giant shadow looming.
The policy cliff. This was absolutely the elephant in the room on the call. Management refused to give 2026 guidance, but they did list specific swing factors.
And the biggest one is the premium tax credits, or PTCs. This is complex, but so critical. What's the issue here?
So right now, the government provides enhanced tax credits that make buying insurance on the ACA exchanges way more affordable.
Obamacare plans.
Exactly. And there's a big debate in Washington right now about whether to extend those credits or just let them expire.
And why does DaVita care so much? A patient's a patient, right?
Not at all. Payer mixes everything in this business. Commercial insurance pays so much better than Medicare. If those credits go away, fewer people can afford commercial insurance. DaVita estimates that if they expire, it would be a $120 million hit to their operating income.
$120 million. That is a massive hole in the P&L.
It's substantial. But, and this is an important detail, it wouldn't happen all at once. Management talked about the roll-off.
How would that work?
It would likely be something like a $40 million hit in year 1, $70 million in year 2, and then $10 million in year 3.
A slow bleed. Why?
Because existing patients, people with kidney failure, they'll fight tooth and nail to keep their coverage. The drop comes from the new patients, people just developing kidney disease, will see the price without the credit and just lapse straight into traditional Medicare.
Which pays DaVita less. It's a slow degradation of their most profitable patients.
That's the risk. And speaking of which, their commercial mix was already down slightly, about 15 basis points.
And what about Medicare Advantage?
That's the other wild card. Management basically said they're agnostic on where the MA mix lands because the market is so dynamic, they don't have a clear line of sight.
It just sounds like there are so many moving parts for 2026. They also mentioned their value-based care segment, IKC.
Right. IKC posted a $21 million loss in Q3. And the catalyst there is this government program, CKCC. They're waiting on the performance results and the timing of when that cash actually hits.
Whether it lands in 2025 or gets pushed to 2026
is a huge variable. It makes their earnings lumpy and really hard for analysts to model.
Hard to model seems to be the theme here. You've got weather, flu, cyber attacks, government policy.
And lumpy payments.
Yeah.
But there was one last piece of clinical alpha they mentioned, something about middle molecule clearance.
Yeah, what's that about?
It's a long-term play. DaVita is researching ways to filter out larger toxins that standard dialysis might miss. It's a 3-year horizon, but if it works, it improves patient outcomes.
And better outcomes means lower mortality.
Which eventually feeds back into the census. It's the clinical answer to the volume problem.
Okay, so that's the landscape. A stock that's been battered, facing a policy cliff, run by a team that's buying back stock and investing in tech. Which brings us to our favorite part of the deep dive.
The This Is Not Financial Advice segment.
And we have to say it. We're not your advisors. Do not do this. This is purely for entertainment.
Do your own diligence.
All right. Picture it. You're the analyst at a multi-manager fund. You're in front of the investment committee. The PM is skeptical. What's the pitch?
I'm pitching the Washington straddle, or maybe we call it the policy arb.
I like it. Set the scene.
The setup is this. The market is pricing DaVita based on the fear of that premium tax credit expiring. That's why the stock is down. The consensus is bearish because of that $120 million overhang.
Everyone is scared of the cliff.
Correct. But here's the trade. You don't bet on the earnings. You bet on the legislation. The long leg of the trade is buying DVA.
Buying the fear.
Exactly. If the credits are extended, which happens all the time in D.C. at the last minute, that $120 million overhang just vanishes instantly.
And the stock re-rate.
The stock re-rates 15 to 20% higher overnight as that risk discount is just removed.
Okay, but what if you're wrong? What if Congress goes into gridlock and the credits expire?
That's the hedge. If the credits are cut, DaVita gets hit, sure. But who else gets hit? The insurers. Specifically, the Medicare Advantage insurers who have to deal with all that churn. So you short the MA heavy insurers against your DaVita long.
So you're hedging the policy risk by shorting the secondary victims of the policy change. That's smart.
That's the idea. But here's the twist, the kicker. I call it the long flu season hedge.
The what?
We just had a severe flu season that drove mortality up and volume down. That is a mean reverting statistic. It is very unlikely to be that bad 2 years in a row.
Okay.
So if mortality just reverts to the mean in 2026, you get a 50 to 75 basis point structural volume tailwind for free.
So you're buying the mean reversion of death and the uncertainty on taxes.
Precisely. You're betting that fewer people will die than the market currently thinks, and that Washington is, well, more predictable in its dysfunction than the current price implies.
That is incredibly dark and incredibly calculated. I love it. It's the perfect example of how the market turns human variables into arithmetic. So let's wrap this up. Main takeaway for the listener.
DaVita is a steady operator that just walked through a perfect storm of temporary headwinds. The flu, the cyber attacks, the hurricanes, and the numbers were a miss against the street, but a hit against their own internal targets.
And the opportunity.
The opportunity lies in figuring out who's right about 2026. Is it the panicked market looking at that policy cliff? Or is it the calm management team that's still buying back its own stock?
If management's right, this dip is a gift. If the market's right, there's more pain to come.
Exactly.
A steady ship in choppy seas. We'll see if they can navigate the policy waves next year. As always, nothing here is financial advice. Do your own diligence. Read the filings.
And keep an eye on Washington.
We'll see you on the next sticker.